Welcome back traders to another video. I hope you had an amazing day. This is Creative Minds, always coming at you with quality content about the stock market updates, investment strategies, swing trade, and day trade opportunities. Today I needed to make a video to address what is happening in the stock market. I believe most investors could make a huge mistake in a market like this. It is easy to make the wrong decisions. Especially when you see the news media and YouTube videos. Every day the media talks about how things can go wrong. We have inflation concerns, rising interest rates, there is the Ukraine and Russia's geopolitical pressure. All that creates huge fear and uncertainty, and seeing the market dropping every day could pressure investors to make emotional decisions and liquidate their assets to stay on the sideline. We might be thinking about how things can go wrong, but this is a huge buying opportunity, and over a long period of time this could give you a huge return. I'm not trying to give you financial advice. Always remember why you started investing. To begin with, build a case for yourself. It is very easy to sell, and there are a lot of reasons that will make it easy to do so. This chart gives a much better perspective for most of us. The problem is, we live in the short term but plan for the long. The basic concepts of investing are pretty simple, but they are far from easy to implement without a long-term vision. One thing we know for sure: despite all this incidents, the market has been continuously creating higher returns over the years. Pain is temporary, it may last a minute or a day or a year, but eventually it will subside. For example, I bought PayPal when it was trading around $200. Right now it is trading at $102. If you like the stock when it was trading at $200, you should love the stock when it is trading at $102, you have to remember that. The same thing goes for other stocks. Now let's quickly highlight a few things. The first is the PE ratio. The price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. This is the PE ratio for S&P 500, 600, and 400 indexes, starting from the year 2000, for the last 22 years. The S&P 500, which is a large cap, the PE ratio still shows about 19, which is relatively considered overvalued. When we look back in 2000 and 2003, we had a similar type of PE ratios for S&P 500. For S&P 400 mid-cap, the PE ratio is at 14, which is pretty low compared to where it was the past 2 years. From the end of 2020 to mid-2021, the PE ratio for mid-cap was between 23 and 26. Every time the mid-cap PE drops to near 14, it usually recovers back with a massive bull run. In some scenarios where in 2008 we dropped to 8 and in 2020 dropped to 10. Those were great buying opportunities. Now let's see the golden opportunity, which is a small cap. Right now the PE ratio for small cap is at 13. Every single time after the PE for small cap dropped or in this low ranges, we had a massive recovery and a bull run. For example, in the worst case of 2008 and 2020, we dropped to 10 but recovered back. Those were also massive buying opportunities. Since February 19, 2021, we have been consistently creating lower lows and lower highs for small cap growth stocks. Currently, there are more than 100 stocks that are down 50 to 90%. Lots of great choices in the market. What are some of the things I keep in mind when I'm looking to buy a stock? The first thing is revenue growth. Second, margin expansion. Third, if the company is profitable, what is the profit growth? If the company is not profitable, then you can ask for the path to profitability so that you can have peace of mind knowing that this company can be profitable maybe in the next 1 year, 2 years. It will give you more confidence. Fourth, a strong balance sheet goes beyond simply having more assets than liabilities. Strong balance sheets will possess intelligent working capital, positive cash flow, a balanced capital structure, and income-generating assets. Fifth is share dilution. Some companies do share dilution. Shareholders' ownership in the company is reduced or diluted when these new shares are issued. You have to keep that in mind, a lot of companies do that. So make sure you check that is it between 10% to 20%. In some cases, companies do share buybacks, which is a very good thing. Finally, check if free cash flow is growing and EBITDA is growing. Now, let's watch a very quick video.
The first chart that I want to show you guys is, first of all, the put-call ratio. This is a classic. We take a look at this all the time on this channel. It gives you a measure of the sentiment, especially the short-term trading sentiment, right? How heavily positioned are traders for the market to go down or for the market to go up? If there's too many calls in the market, so this ratio is extremely low, that's when you should be booking profits on your S&P 500 gains. But when there's lots of puts, meaning a lot of people are betting for the markets to go down, that's when you should be buying the dip. So no indicator should be used alone, and our convictions are based on a lot of different factors, but this is definitely one of our all-time favorite indicators, right? Just how successful it's been at timing market bottoms. Let me quickly show you the S&P 500 on top of this chart. This was the COVID panic, huge spike in puts, and look at this, it spikes up at the market bottom right here. And then all spikes that came after that were moments to be buying the S&P 500 and not panic like most people are doing right now, expecting some kind of massive bear market right now. We're going to take a look at more data in just a second, but this is not telling me to panic. It's telling me to look in the opposite direction from the herd.
That's a great point. The put-call ratio is a measurement that is widely used by investors to gauge the overall mood of a market. If traders are buying more puts than calls, it signals a rise in bearish sentiment. If they are buying more calls than puts, it suggests that they see a bull market ahead. Currently, more traders are betting against the underlying, and hence the general outlook is bearish.
Now, speaking of the herd, let's quickly take a look at this. This is the AAII Bulls survey, right? This is, again, another huge measure of sentiment. It's one of the oldest surveys of sentiment, so that's great. We have a lot of data that goes back a very long time ago. And they basically ask investors, or at least the AAII pool of investors, whether they're bullish on the stock market over the next 6 months or not. And so here you can see the number of bulls there are in the market. And ever since March 2021, we've had the sentiment absolutely drop like a stone. In fact, here, look at this reading here. We are currently at 19.2% of investors bullish on stocks. So there's less than 1 in 5 investors that are bullish on the stock market right now. Everyone's waiting on the sidelines. Everyone's paying attention to what the Fed is doing and the hawkish concerns over inflation. Now, don't get me wrong, right? There are some legitimate concerns behind this, but when everyone's looking at the same thing, look in the opposite direction. In fact, I wanted to take it a step further, so I back-tested this indicator to actually go back and see how many times we've had this type of reading, meaning we actually have under 20% of investors that are bullish on the stock market. And you can see over the last 20 years of stock market data, we've had this reading 5 times, not including this one. And every time it gave absolutely massive returns over the next year, over the next few months. We had the same reading in 2005. At the very, very bottom of the 2008 financial crisis, right before a 12-year bull run. In 2013, right here, at the bottom of this 2015 correction here, we had a sideways period of consolidation on the stock market. You had that reading at the bottom of it. And we have the same reading now. Now think about how sentiment works. If everyone's scared, everyone has cash on the sidelines, then that means there's a lot of buying power to take this higher. It's a lot more likely to go up and not make a big top. So those are 2 ways of looking at sentiment, put-call ratio and the AAII survey. Both of them are telling us that we should look the other way.
Another good point is the AAII survey. The percentage of investors who think stocks will rise over the next 6 months plunged to its lowest level. The results from the latest AAII sentiment survey saw bullish sentiment drop to its 29th lowest level since the survey started in 1987. In addition, the percentage of investors describing their outlook for stocks as neutral decreased while pessimism increased. As noted above, bullish sentiment is at an unusually low level for the 6th consecutive week. Historically, the S&P 500 index has gone on to realize above average and above median returns during the 6 and 12-month periods, following an unusually low reading for bullish sentiment. The bull-bear spread, bullish sentiment minus bearish sentiment, is also unusually low at 23.9%. Such readings have also been historically followed by above average and above median returns for the S&P 500 over the following 6 and 12 months.
In fact, this is where I wanted to take a look at this fund manager survey from Bank of America. Now, we usually don't take a look at what the banks have to say. They often try to mislead the average investor into making poor decisions. But their fund manager survey is extremely useful to actually know how funds are positioned. And you can see this is just absolutely fascinating how funds are currently positioned in the exact opposite way as our convictions. They're currently very overweight in the banking sector, which means they expect yields to rise because banks perform well when yields are rising. They're heavily positioned in cash, meaning that they expect the stock market to drop and for there to be better buying opportunities. And they're underpositioned, underweight in bonds, US equities, and tech. And those are the three things that we expect to rally very hard in the next few weeks. Now, why am I saying this? And why do I sound so happy about it? Because if funds are overweight in cash, that means there's a lot of cash on the sidelines waiting to buy what they're currently underweight in. And that's bonds, that's US equities, and tech. So I think funds are going to be selling the banks to buy tech and to buy bonds to rebalance their portfolio.
Finally, fund managers have been flocking to cash ahead of hawkish Fed meeting. They are sitting on a massive amount of cash. When the floodgate opens, with a number of shorts in the market, we will see massive bull runs in the near future. Thank you guys for being here, I hope I added value. If you are here for the first time, please do not forget to subscribe to this channel. With that, I'll be seeing you in the upcoming videos.